Hello and welcome back to Auspice as we take a look at the global view on this Tuesday. I'm Andrew Gagan, good to have you with us. Well, let's see what happened overnight. US and UK markets, they were closed on Monday for holidays. Global equity markets elsewhere climbing and the euro rallying after President Trump delayed his threat to impose 50% tariffs on the European Union. European shares began the week positively, recouping the previous session's losses with the Pan-European Stock 600 index closing around 1% higher. Defence companies are among the biggest boosts, with Rheinmetall and Leonardo gaining more than 3% each, pushing the aerospace and defence index higher. ThyssenKrupp shares surged on reports that the submarine and car parts manufacturer plans to hold a shareholder meeting in August to approve an expected spin-off of its warship division. And luxury stocks exposed to the US market gained, including Kering, LVMH and Richemont. Well, the United States and the European Union have agreed to fast-track trade negotiations following President Trump's reprieve on 50% tariffs on EU imports. President Trump nominating July 9th as the deadline to allow talks between the US and the 27-nation union to produce a deal. The EU also wants to see an end to 25% tariffs on steel and cars, and for President Trump to drop his so-called reciprocal tariff, which was provisionally set at 20% for the EU, but is being held at 10% during that pause until July. In the latest Fed speak, FOMC member Neel Kashkari has said the administration's policy shifts are creating uncertainty for Fed officials, saying anything is possible, but will the picture be clear enough by September? I'm not sure right now. We'll have to see what the data says, but also how the negotiations are going. Well, locally, the Australian three-year government bond yields have fallen to 3.42%, the 10-year down to 4.34%. Markets pricing in a 70% chance the RBA will cut the cash rate again by 25 basis points at the next meeting in July, with 3 more cuts in the easing cycle. Currency-wise, the euro has hit a one-month high against the US dollar. Meanwhile, ECB President Christine Lagarde has said the euro could become a viable alternative to the dollar, saying the ongoing changes create the opening for a global euro moment, and the euro will not gain influence by default, it will have to earn it. Greenback makes up some 58% of international reserves, the lowest in decades, while the euro has a 20% share. And Bitcoin is currently trading above 109,000 US dollars. Checking in on commodities, oil prices have held steady with news that 8 OPEC Plus countries which had pledged extra voluntary oil output cuts will now meet on Saturday to decide future output. Brent crude futures at $64 a barrel. Copper is little change, while iron ore has fallen more than 1% to $98 a tonne, and the gold price easing around 0.5% to $3,342 an ounce. All right, let's get more on what we're seeing across global markets at the moment. Greg Smith joining us from Devon Funds Management out of Auckland. Greg, good to catch up with you again. Let's start, certainly what we're seeing from the Trump administration's point of view, the latest backflip, of course, with Donald Trump handing out a reprieve to the EU. What have we seen in market reaction? Of course, it comes at an interesting time because we've had both the US and UK markets closed.
Yeah, absolutely. I mean, obviously, we've seen lots of backtracking. We've seen pauses. We've seen sort of things pushed down the road. And yeah, it's becoming known affectionately as taco time. Trump always chickens out, and giving us a little bit of a giggle to say that, but that is the reality. I think the administration is losing a bit of credibility. The bark's sort of worse than the bite, almost, as it were. So, the egg time is sort of running down on the 90-day pause. So, we've only got a few weeks there. In reality, we've had one deal. We've had the UK. We've had a sort of an understanding, I suppose, with respect to China, but that's not sort of done and dusted by any means. We haven't had a deal with Japan. That was meant to be one of the first. We haven't had a deal with India. So there's going to have to be a flurry of deals. So I think what the reality is, and obviously markets have rallied since the lows in April. The worst case scenarios painted on that board, they're not going to play out, and it doesn't look like they'll play out at all. But just do think there's a little bit of credibility being lost. That said, obviously, Europe did sort of listen, didn't they? So he threatened the 50% tariffs. They had a great meeting, or a very nice meeting by all accounts. did Trump and Ursula, and now it's they're sort of best of friends again. So obviously big relief in Europe. You had the DAX rally strongly, you had automakers up, you had the European indices up. So this is probably sort of setting the tone that I think the administration is losing a bit of credibility, but also it may also mean for investors that despite the whiplash effect almost of these threats and then sort of conciliatory moves, that the worst case outcomes aren't going to play out. So we'll have to sort of see where that goes. But the US futures are pointing up strongly. But the big thing, we need to sort of see some more deals sort of coming. And I think Trump's hand was forced a little bit. You look at Europe. Yes, they run a goods trade surplus with America, but there's a services deficit. They're the second largest importer of US products. Meanwhile, Europe has done deals with the UK and the like. So I think this is good news for markets in terms of volatility sort of pulling back, and we're not going to see those worst feared outcomes. But I think attention will also soon swing to what does this mean for inflation. We've heard various sort of Fed comments, and it's clear tariffs aren't going to be the worst case, but they're going to be higher than what they were pre-April. So I think that'll start featuring into investors' thinking.
Yeah, do you think equity market investors are overly optimistic, given, as you point out, there are no solid deals being done, particularly with China and more recently with the EU, and also, I guess, bearing in mind what we're seeing with the bond market at the moment?
Oh, absolutely. I think you're right, Andrew. There's a degree of complacency. They're sort of almost not quite buying the rumour, but they're buying something that isn't there in writing just yet. So, if China were to come out tomorrow, and obviously they've already raised some concerns recently about the treatment of Huawei, that could sort of really upset things. And meanwhile, it looks like America's being increasingly isolated, and it was in those early days, wasn't it? So you've got China, I think they're due to meet Europe and talk soon. So they're making contingencies. We've got this, in between all the focus on Europe, we've had this mic drop moment, made in China, making that, their version of making China great again. They're working towards that. So they're making contingency plans, and it's probably the American needs more China than vice versa. So I think you're quite right. There's a lot of optimism creeping in there, and that could easily go away if, say, China were to backtrack, or that was to sort of resurface again in terms of tensions there. And we need, look, some of these smaller nations, to be fair, it's not really going to matter to investors whether we get deals with some of those minnows. But I think Japan, India, obviously we've had China, we've had the UK, we've got Europe. We need another few other big nations. Some of those Southeast Asian nations, South Korea, we haven't had anything there yet either. So I think there is a lot of optimism going in there, which could easily sort of recede if there was some stumbling blocks on the trade front.
Meanwhile, Greg, in your part of the world, the RBNZ meeting tomorrow, expectations of another rate cut. What are they seeing in the economy that would prompt another cut?
Well, yes, we had the budget over here last week, and that just confirmed that our economy is in a pretty poor place. We're crawling out of recession. Our cash rate or the OCR is just around about where yours is, and obviously the Australian economy is much better. Now, the RBNZ engaged in 3 50 basis point rate cuts in a row. The last meeting they sided with 25. The bookies' favourite is for another 25. Some are even saying that they might not move at all. I think that would be completely the wrong decision. So look at what's going right for New Zealand. We've seen it in the earnings season today. The export's doing well, agribusiness is doing well, but a lot of areas are struggling. Retail's doing poorly. Card spending figures have been quite fragile. Whilst the banks are saying we haven't seen arrears tick up yet, people are sort of doing it tough. We've seen that from some of the retailers. So the export side's doing well, but the domestic side is still very challenged. Our economy is barely growing. Tourism's going quite well, but then again, we've still got the brain drain continuing. New Zealand has lost its appeal and continues to lose its appeal as an economy in terms of job prospects and the like. So I think it's interesting. So our OCR is currently at 3.5%. The neutral OCR, which I think it should be at now, which is where it's not stimulating or contracting the economy, is 3%. We should be there now, but you're seeing lots of assessments of where that neutral OCR sit a lot lower than where the RBNZ thinks. So you're looking at sort of 2.5 to 2.75%. So you could actually make the case we need another 100 basis points of rate cuts just to get our domestic economy going again. Now, obviously, Adrian Orr's gone, but so we'll have to see what they say. But there's certainly lots of challenges domestically.
Indeed. Well, meanwhile, of course, it comes amidst earnings season. What are some of the highlights you've been looking at?
Well, we've had exporters, and Napier Port springs to mind. Not our biggest port by any means, but they're going pretty well. Logs, kiwi fruit, horticulture, apples are sort of flying out the door. So our export side of the economy is doing well. That should also be confirmed by Fisher and Paykel, which is our biggest company. Now that reports tomorrow, same day as obviously the RBNZ. It's the exports doing well. The domestic side is not doing so well. So Briscoes, which is one of our big retailers, which has sort of done very, very well and been very resilient, is even now saying, things are tough. Early days in the earnings season, the real test, Andrew, is going to come in the next sort of few days. So we've got Fisher and Paykel, we've got Infratil. There's been lots of executive buying there since February. That's in terms of their data centers business, that's very important to them. So obviously very related to the AI thematic optimism around that. We've got Ryman Healthcare, which is a big retirement name on Thursday. That's still tied to the property market, which also is still very tepid, I should say here. They're going to be sort of some key results I think that we'll be looking at. And Mainfreight, I should probably say as well, which again is an exporter, but 75% of the earnings are tied to Australia and New Zealand, so we're expecting a reasonable good result there. So we'll know a lot more in a week's time, Andrew.
Indeed. Greg, great to get across what you're seeing there. Thanks for joining us from Devon Funds Management.
Have a great day.
Let's refocus then on where we're likely to begin on this Tuesday. SPI futures indicating positive start, up 0.25%. That's in the absence, of course, of any lead off Wall Street. We'll get it right across that in just a couple of minutes. Stay with us.